All right. Well, good morning or good afternoon, everybody. It is what is it? Monday, the 17th of August. So here we are with my weekly market update. Appreciate you all joining me. So let's go ahead and dive in and talk about what we are going to be talking about today. So first and foremost today, we're going to talk about a rate update. So I'll give you kind of a rough idea of where rates are right now and kind of what's going on with the market. But a majority of this time, we're going to be spending talking about the saga of Fannie Mae and Freddie Mac. And I'll give you kind of some history on where they came from, where they're at right now, and where they're going. We are in for a wild, wild ride. And I'll explain to you and give you some insight into what that means and how that's going to impact you and your buyers going forward. But let's go ahead and dive in now and get started. So first of all, a rate update. So as I have told you guys over and over again, rates are super good. They continue to stay stable or improve. We've seen a bit of a pullback in the last week, and you kind of see it right here where you see the drop in, and hold on, let me get my little pointer thingy here. So you see the drop in the market here. This is up is a good thing. When this number moves up, it means that rates are getting better. When it moves down, it means rates are getting worse. And so what you're seeing here is in the last week, things have gotten a little bit worse, but it didn't really translate to consumers. A little bit of drop. We saw things come down just a bit here, but it hasn't been a major impact. From a more global perspective, I want to back up here and give you a bigger picture going back. This slide takes us back to November of last year. And so we saw rates were pretty stable. They got better, they got really bad, and major movement in March, and then they've stayed pretty stable. We've seen some drops where rates, and again, down is bad. So we've seen sometimes that rates have gotten a little bit worse, and then they've gotten better. And right now we've seen them get a little bit worse. But again, a lot of that is being absorbed because mortgage companies aren't passing along all of the savings on interest rates for multiple reasons. So we're not seeing that much of an uptick. And we've already seen a turnaround today, and things are starting to move the right direction. So bottom line is, my advice has not changed. If you are looking to purchase a home, lock as soon as you can. If you are looking to refinance, start the process, but don't lock. And we will get the lock done once we've got the loan fully underwritten, approved. And that is the smartest strategy to get you through your loan process. So let's go ahead and dive into the meat of what I want to talk about today. And that is Fannie Mae and Freddie Mac. So first of all, I want to talk about kind of who are Fannie Mae and Freddie Mac and why do we care so much about them? And as this weekly webinar has kind of become a diary, if you go back through my YouTube videos, it really has built upon each other at certain periods since March when the pandemic started. And we're at one of those turning points right now. So Fannie Mae and Freddie Mac have come to the forefront in the last week in the mortgage industry. And I think it's something important for you guys to fully understand how that's going to play out on the real estate side. So first of all, who are Fannie Mae and Freddie Mac? They are what we call government-sponsored entities. We use the term in the industry, the GSEs, or the government-sponsored entities. They were originally private. And Fannie Mae, as a matter of fact, was established back in 1938. And Fannie Mae's charter was to help sustainable home ownership in the United States coming out of the Depression. So think about the time frame, 1938, we're just finishing up the Great Depression. We're heading into World War II. Obviously, we don't know that at that time, but we're trying to increase home ownership and create some stability in the financial lives of the American population. And so Fannie Mae, excuse me, is basically the reason why we have a 30-year fixed rate mortgage. Because in almost every other country, there is no such thing. No bank wants to loan their money and have it loaned out for 30 years and have a interest rate determined at the beginning of that time frame on how much they're going to earn in interest over the life of the loan. Excuse me. So it creates a bit of a unique market we have in the United States, and most realtors in our market don't even understand that this is a very, very unique thing in our country, that we have a 30-year fixed rate mortgage. And that's specifically because the government chartered Fannie Mae in 1938. And then in 1930, they had chartered Freddie Mac, the Federal Home Loan Mortgage Corporation. If you didn't know Fannie Mae, by the way, it's called Fannie Mae, FNMA. Get it? Fannie Mae. But it stands for the Federal National Mortgage Association. Freddie Mac doesn't really sound like Freddie, but it's FHLMC, and it is the Federal Home Loan Mortgage Corporation. They are both now shareholder-owned companies, but they operate under congressional charter. That happened in 2008, and they're run by the FHFA. So let me rewind and show you kind of some history of what happened. Actually, I'll do that in a minute. Let me finish real quick. They invented the 30-year fixed mortgage. I talked about that. Their role is simply to provide liquidity, stability, and affordability. So they buy loans from us, the lender, and then they either hold them on their own portfolio or they sell them to Wall Street, and they guarantee the timely payment on the mortgage bonds. That attracts investors that might otherwise invest in something else. So if you think about that, you got people investing in the stock market or buying 10-year treasury bonds, but they want a little bit more return with a reasonable amount of safety. And mortgages represent that because mortgages pay a better rate of return than a treasury bond, but you're dealing with individual homeowners that may or may not be able to pay. And that's where Fannie Mae stepped in and said, look, we're going to provide a concrete set of guidelines that if we've backed a loan, it means it's met all of our guidelines. That their income is good enough, their credit is good enough, their down payment is good enough. We put our seal of approval on that loan. And that in and of itself sets a gold standard for Wall Street to say, oh, I'll invest in that loan, but what happens if they don't pay? So Fannie Mae and Freddie Mac added a guarantee. They guarantee timely payment on the mortgage bonds. If that mortgage is not paid on time and it gets behind after a certain point, they guarantee that the payments will get caught up. So that's really their role. But let's talk a little bit more in detail about it. So first of all, as I mentioned, did I have this twice in here? Was that the same one? Oh, oops, kind of the same stuff. All right, let's move on. So what happened in 2000 to 2007? So the GSEs, the government-sponsored entities, a lot of people blame them for the collapse in the housing market. The truth is it wasn't their fault. They had nothing to do with it, but they made a wrong decision at one point in time. So here's what happened. The GSEs lost market share in the bubble. They went from 50% of all loans being backed by Fannie Mae or Freddie Mac in 2002 to only 30% of all loans being backed in 2006. And if you think about that, that's a lot of the loans back in 2002 that didn't refinance are a majority of those 30% that were left over in Fannie Mae and Freddie Mac's books. Most new mortgages taken out between 2002 and 2006 were not backed by Fannie Mae and Freddie Mac. It was all of the wild finagling going on between mortgage banks and Wall Street, selling mortgages directly to Wall Street, breaking up into tranches, and I won't go through all of that. Watch The Big Short. It'll explain to you all of what happened and why. But the bottom line is Fannie Mae and Freddie Mac did not cause the housing crash, but they made a fatal decision. In 2006, Fannie Mae and Freddie Mac said, guys, we are making a bad decision and we're losing money. And that bad decision is there are what we call Alt-A loans. Those are people that they have good credit, they have a good down payment, but we can't prove their income. Let's go ahead and get, those people don't represent much risk, and Wall Street's doing those loans all the time. So let's go ahead and qualify people without proving their income. So that was Fannie Mae and Freddie Mac dipping their toes into the water of subprime lending. But here's what happened. It bit them, and it bit them big time. In 2008, Fannie Mae and Freddie Mac together had a $47 billion loss. Half of that came from Alt-A loans, even though only 11% of their portfolio was Alt-A. So very, very bad decision. It cost them a boatload of money. Over the next 4 years, $265 billion was lost between Fannie Mae and Freddie Mac, and 60% of that was attributed to the risky loans they bought in 06 and 07. It cost the Fannie Mae and Freddie Mac shareholders 100% of their equity in the company. Because in September of 2008, the federal government stepped in and they privatized, they moved the private market of Fannie Mae and Freddie Mac under conservatorship of the federal government, and all of the value of the shareholders went to zero. If you held stock in Fannie Mae in August of 2008, it was worth nothing in September of 2008. And then Congress went and started digging deep into the pockets of the American mortgage person, the American homeowner getting a mortgage, and they added what they called guarantee fees. And Congress started adding, they added 20 basis points of guaranteed fees. Now, 20 basis points on a $1 million loan is $2,000, okay? So we're talking $2,000 on a 20 basis points 200 basis points is 2%. $1 million, sorry guys, I'm going brain dead. On $1 million, 1% of that is $10,000. So yes, it's $2,000. All right, making sure my decimal point is carried over correctly. So $2,000 on $1 million of loans. Then they added another $1,000 every $1 million of loans. Then they added another $1,000 every $1 million of loans. So they are getting $4,000 for every $1 million of mortgages in the country go straight into Congress's pocket, because that money falls to Fannie Mae and Freddie Mac. But every year, Fannie Mae and Freddie Mac, because they are in conservatorship, have to turn over all of their profits over to the coffers of the federal government. So everybody talks about how the mortgage industry got bailed out. The truth is the federal government is enriched by Fannie Mae and Freddie Mac because they are continuing to receive these payments from Fannie Mae and Freddie Mac for these guarantee fees that are built into mortgage rates. It's the reason why up until the most recent issues we've dealt with coronavirus and the economic problems we have this year, it's the reason why we had jumbo loans as cheap or cheaper than conventional loans, because Fannie Mae and Freddie Mac have continued to add a tax to conventional loans that don't exist on jumbo loans. And so the price of jumbo loans didn't come down overall. Now the market may have come down, but jumbo loans themselves did not become less expensive. Conventional loans became more expensive because they added these guarantee fees. So when you look at the market today, 62% of all first liens are federally backed. So that's kind of the history of Fannie Mae and Freddie Mac. They've served as this backstop. They got blamed for collapsing the economy when it wasn't their fault. And now they're in conservatorship and they are losing all of their profits to the federal government every single year. And they're run by an agency called the FHFA. That's the Federal Housing Finance Administration. And the FHFA is the key to this entire story that I need you to understand. The FHFA is currently run by Mark Calabria. Okay, so if I had a soundtrack, this would be where the dark villainous soundtrack, like when Cruella de Vil comes out in 101 Dalmatians. When I say Mark Calabria, think Cruella de Vil. Okay, I'm kind of kidding, but kind of not really. Okay, so Mark Calabria is the head of the FHFA. The FHFA is simply the regulator that was created for the sole purpose of overseeing Fannie Mae and Freddie Mac. So they are the conservator overseeing Fannie and Freddie. And that job that was created in 2008 was created with autonomy from appointment or removal by the federal government, by the president. What that means, there's only two jobs in the entire federal government, basically, that does not serve at the whim of the president. Those two jobs are the head of the FHFA and the head of the CFPB. Now, I want to be clear about what this means. Everybody else, every other head of every other agency, the president, and I'm not going to get political, you choose whether you like them or don't like them. I'm not going to ask you to share your opinion. I'm not going to share mine. I'm simply going to tell you it is the president who chooses to say, I don't want you in that position anymore, you're fired. And the president does not have to have a reason to fire anybody that serves on his cabinet, doesn't have to have a reason to fire anybody that runs any government agency, okay? But the president cannot fire the head of the FHFA and the president cannot hire the head of the CFPB. A month ago, the Supreme Court ruled that the ability for the CFPB to be run by a, quote, dictator who cannot be removed at the whim of the president is unconstitutional. So the only remaining position left in the federal government where somebody can make any decision they want, and who cares if the president agrees with them or not, because they have no recourse, is this guy right here, Mark Calabria, who runs the FHFA. And I'm gonna give you a quick background on Mark Calabria, and I'll read you the statement real quick. Before Congress in 2011, Mark Calabria said, reducing the competitive advantage of Fannie Mae and Freddie Mac by increasing their fees would help raise revenue and would level the playing field in the mortgage market. I'm going to pick that apart real quick. So what he's saying is, let's make mortgages more expensive. Let's add to the fees that we're charging on mortgages that are backed by Fannie Mae and Freddie Mac, because that will raise revenue. Where's the revenue going right now? In the pockets of the federal government. and it will level the playing field. In other words, what he wants is he wants to bring in private money. Private money does not exist right now in the mortgage market. There are very few private investors. Jumbo loans are private money, but that's individual banks loaning their money. There used to be a market where jumbo loans were traded and sold, and that market disappeared in the meltdown back 10 years ago. So he's trying to recreate a private market. I don't think that's a bad thing, but the fact is he's trying to do so by making Fannie Mae and Freddie Mac way more expensive. But right now, nobody else is willing to fill the void. So if he's going to win, he's going to keep making Fannie Mae and Freddie Mac's loans even more expensive in order to, at some point, create a vacuum, create a hole where private market can step in and say, oh, well, I can make a profit if I charge a little bit less than what Fannie Mae and Freddie Mac charges. And so he's made it super, super clear that he wants to privatize Fannie Mae and Freddie Mac. And as he put right here in the second part, no private entity can compete with Fannie Mae and Freddie Mac right now. So he 100% wants to make them more expensive, and he's proven it. So here's what he's done so far this year. And you guys, I shared all of this with you as it happened over the last 6 months. So the CARES Act was passed in 2020. In 2020, obviously. In March of 2020, the president passes the CARES Act. That's the act that created the PPP loan and the SBA loan to help people with businesses that are struggling through this economic challenge. And it also gave homeowners the ability to file forbearance. And it required that homeowners simply need to ask for forbearance, and they simply need to say that they are, in fact, harmed by the coronavirus shutdown, and they can get a forbearance. In the CARES Act, it stipulates very clearly that the FHFA should create a line of credit for all non-bank mortgage companies. People like Summit Funding, people like Quicken Loans. We're not banks. Banks can go to the federal government and borrow money directly. They have lines of credit through the Federal Reserve, through the Treasury, that they can borrow directly. And if they need to use that money for their auto loan division or their mortgage division, they can use the money any way they see fit. But non-bank mortgage companies don't have access to borrowing money from the federal government. Yet the CARES Act said, we have to cover the payment for every mortgage holder that goes into forbearance that doesn't make their payment. We, as the mortgage bank, are writing the check. So now you're stuck. If you're a real bank, cool, we'll write the check because I can go get money from the federal government through the Treasury. But if you're a non-bank, you don't have a choice. So the president, when he signed the CARES Act, said, FHFA, you need to create a lending window, an ability for a line of credit for banks for non-banks to borrow against when they have to cover all these mortgage payments. And Mark Calabria refused. And that caused the wild swings in interest rates that we saw in early March, because he said, nope, you guys are on the hook. And now banks are afraid of mortgages, and non-bank companies are even more afraid of mortgages. Now we fast forward a couple of months. Again, none of this should be new information to you because you've all been listening to me as I've been talking through this process. By the way, guys, if you have questions about anything, please feel free to post in chat or Facebook chat or Zoom chat, depending upon where you're at, and I'm happy to answer those questions as we go. So May of 2020, Mark Calabria comes out and says, you know what? I know 2 months ago I told you I wasn't going to provide you with any lending facility to help with people who have gone into forbearance, but I'm actually going to make it worse. I'm now going to require that anybody who takes out a home mortgage and files for forbearance before you sell it to me, Fannie Mae and Freddie Mac, that you, if it's a purchase or a refinance of what they owe, then you, the bank, take a hit, pay a fee of 700 basis points. That's 7% of the loan amount. That's greater than what the average, realtor commission averages 5 to 6% ish. And we're not allowed to talk about that, so I'm not talking about that, but I'm giving you some perspective here. This is 7% of the loan amount that Mark Calabria says, okay, fine, I'll buy your $300,000 loan, but write me a check for $21,000 for the privilege of taking that off your hands, only because the client had a job when we closed escrow, but a couple of days after we closed escrow, they lost their job and they went into forbearance. And as the mortgage bank, we're supposed to eat that $21,000 loss on a $300,000 mortgage. That created another huge pullback in the market, especially on cash out refinances, because he went on one step further and said, oh, by the way, if the consumer was doing a cash out refinance, you cannot sell us the loan at all, which means we have to hold the entire $300,000 on our balance sheet. The problem is we're not a bank. We don't have deep pockets like a bank does because they've taken in deposits. So where do we put that? Because back in March, he said he wouldn't loan us any money. And now he's refusing to buy loans that otherwise should have been bought simply because somebody went into forbearance after they closed escrow, after they proved they had a job, and now we have to hope and pray that they don't lose their job before we sell it to Fannie Mae. Does this sound like someone who's on our side trying to help us promote homeownership, or someone who's trying to line his own pockets and his constituents, who are Fannie Mae and Freddie Mac, and line their pockets? And here's the final straw. August of 2020, last week on Wednesday, they announced an across-the-board fee on all refinances. And they came out and basically said that effective for any loans that you sell us, Fannie Mae or Freddie Mac, on September 1st or beyond, we're going to add an extra 0.5%. Okay. So that, by the way, guys, I talked about the guarantee fees being 40 basis points. This is 50 basis points. So this is $5,000 on every $1 million of loans that we have to write a check for just because they changed their fee structure. And the average refinance is locked at least 15 to 30 days before we close escrow. So that means they told us on April 13th, April 11th maybe, that that if you don't sell us a loan by April, they told us August 11th, last Wednesday. If you don't sell us the loan before September 1st, we're going to charge you a 0.5% fee just because it's a refinance. And most banks, they don't have, well, all banks, we don't have the choice on a loan we've already locked of adding that fee to the consumer. So it's a tax against the banks that's hurting the non-bank servicers the most because we don't have anywhere to go to borrow that money from to get us through in the short term. It is clear to me and to the people that I follow and listen to that Mark Calabria is not a fan of non-bank mortgage companies. He wants two things. He wants all mortgages to go through a bank. Think about that for a minute. What's the quality that you've received from the typical bank loan officer? And I used to be a bank loan officer, but the truth is it's a whole different process. And Mark Calabria clearly is not a fan of non-bank servicers, and he has us in his target. Okay. The second thing is, in general, he wants Fannie Mae and Freddie Mac to represent a smaller portion of the market. We saw what happened when Fannie Mae and Freddie Mac represented a smaller portion of the market. The market lost their marbles and started doing loans that they shouldn't have done. And it created a very, very big problem. So this is a huge challenge that we're dealing with right now. And here's basically what he said. And I'll give you some context here. If you think about any department within the federal government, they are all bleeding money right now to find a way to help people through this economic crisis that we're dealing with right now. Whether it be the Treasury, whether it be the the housing, not housing, unemployment is bleeding money and spending a whole bunch of money. SBA is bleeding money and spending a whole bunch of money. Whatever we can do to get money in the pockets of consumers, every single federal government agency is pushing money out to the consumers and to the businesses to help them. Wait. Everyone except for the FHFA, because they're saying, oh, well, let's go ahead and pull in some money. And we're going to call it that there's economic uncertainty. So Fannie Mae's statement last week said, in light of market and economic uncertainty resulting in higher risk and costs, we're implementing this fee. Freddie Mac stated a little different. We're implementing a new market condition credit fee for refinances as a result of risk management and loss forecasting precipitated by continued economic and market uncertainty. So some really smart guys with some really great thesauruses came up with all of these big words. The truth is it has nothing to do with market uncertainty because they have the backing of the federal government and they are making money hand over fist. I meant to put this in here and I forgot to put it in. It is some crazy, stupid number of how much money Fannie Mae and Freddie Mac made in the second quarter. Like billions of dollars that they earned in profit in the second quarter, way more than they've ever earned in their entire history. They made a boatload of profit in the second quarter simply because so many people are refinancing. But now they're saying, well, we need to line our pockets a little bit more because we're concerned about some economic uncertainty that's going on. And because of the economic uncertainty that we're concerned about, we're going to ask for an extra 0.5% on every single loan. The Fed, the Treasury, is up in arms because they're like, wait a second, we're writing checks hand over fist to buy mortgage securities to keep interest rates down on mortgages. And we've got our sister department in the federal government taking that money out of the pockets of the consumer and lining their own pockets with that money. Guys, this is super scary, and this is real stuff that's happening right now. So here's what I'm going to kind of wrap here because we got just a couple minutes left. Here's the bottom line. It's clear, and here's another statement that Calabria made, moving more of the mortgage sector to banks and thrifts would ensure there's at least some capital behind our mortgage market. He has clearly said in the past he is not a fan of non-bank mortgages. So here's the question. Where does this all lead? The first thing is there's been a lot of conversation about Fannie Mae and Freddie Mac exiting conservatorship. But what does it look like? Because they still need to have the backing of the federal government. So is it fully privatized with just the backing in bad times? Is the government a partner in lending? I don't know. What I do know for the future of mortgages in the short term is that we have a really volatile environment where you're going to see some banks raising their rates simply because they can't trust the source they sell mortgages to. The FHFA, Fannie Mae and Freddie Mac, are a partner to mortgage companies because that's who we sell our mortgages to. And if you're in business with a partner and you learn that you can't trust that partner because they're making moves that are contrary to what is in your best interest, you better keep some extra money on the side just in case they do it again. Now, Summit Funding made the decision, we're only passing on half of that cost. So we're eating 0.25% of every loan amount. Every loan we do, 0.25% of that loan, we are eating. If it's a refinance, we're only passing on 0.25% of that. So we're trying to do our part to mitigate this increase in cost. There's a lot of scuttlebutt that maybe Fannie Mae and Freddie Mac will repeal this because everybody is up in arms. But the fact is, we got to be careful what we wish for. Because if we switch from having a majority of our money going to Fannie Mae and Freddie Mac, and instead we have a mix of public and private funding, it's going to look a lot like what you see today in jumbo and non-QM loans. It is a nightmare. You call one bank and say, hey, can you do a loan? And if it's a jumbo loan, that bank's going to say, well, you got to have 25% down, 800 credit scores with a year's worth of reserves. You call a different bank, oh no, I'm good with 20% down, 750 credit score with this much in reserves. You call a third bank, they're going to give you a whole different answer. The same in the non-QM, the loans that are using your bank statements and what credit score do you have to have for that and how much reserves do you have to have. Every single lender is different. They all have their own appetite. If Mark Calabria gets his wish and Fannie Mae and Freddie Mac increase their costs so much that private money flows in, it is going to be a nightmare because every single loan is going to be different depending upon the bank you're talking to because they're using their own guidelines instead of a standardized set of guidelines. Guys, that is super scary for the future of the mortgage and real estate market because we could be back in the wild, wild west, and that can create some major challenges going forward. So, on that note, I'm going to wrap up. I got 1 minute left. I want to remind you of my upcoming webinars. I do have group chat I'm looking at here. So if you have a question about anything, post it in the group chat on Zoom. I'll answer it as we wrap. Or if you have a question on Facebook, post it on the chat on Facebook and I'll respond there as well. But I've got 3 webinars already scheduled coming up. So I've got my 6 steps to financial freedom. I'm doing this Thursday. I help people get into the most debt they've ever been in their life, and I want to help them get out of debt. And so I'll be hosting that webinar this Thursday. Next Thursday, I'll be doing my first-time homebuyer webinar. So love any buyers that you've got. Remember, I am realtor friendly, so I promote the use of realtors, obviously, but I do not let realtors talk about themselves in that webinar. I don't promote any realtors. There are no realtors presenting. So you can send your buyers knowing you're not going to get poached by another realtor. And then September 3rd, I'm going to be doing renovation loans, how to refinance and purchase a home or repurchase a home and get funds for renovation at the same time. So if you want to register for that, go to rsvpwithjohn.com. It is 3:30 exactly, right on time. Any questions, feel free to ask. Otherwise, guys, have an absolutely amazing day. I appreciate your support and would love to help you and your buyers with any financing needs that you got. Give us a call and we'll love to take care of them. All right, guys, see y'all later. Bye-bye.